Good evening. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. These ongoing videos are about using our closed-end fund investment strategy. If you want the full methodology and our 12 steps to financial freedom, then head over to Facebook and check out my page there called Adapted Perspective Navigate Your Finances, where I give you the whole framework for free. Uh, this is yeah, we'll get through the basic stuff. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So I am going to attempt to streamline past videos and really trim down the overall video and yes, give you my take of things, but also give you the contextual reference to what I'm saying or what I'm talking about, and get into the picks quicker than later. Uh, so after, gosh, I think I've said the same thing for weeks. So let's start with why I like closed-end funds. Discounts. Do you want to pay full price for something? Because I certainly don't. You get amazing discounts. You get amazing dividends. The average right now is like 8.3% across all closed-end funds, and that means some don't pay any, and some pay an obscene amount of dividend. So current average at 8.3, that's a lot better than what you're seeing in the general market, and that's a heck of a lot better than the current inflation rate. You have opportunities across all sectors. If you want portfolios in a can, if you want energy or utilities or infrastructure or this or that or the other, you can, I don't want to say pigeonhole, but you can focus yourself solely on one thing. Like we have portfolios that invest solely in master limited partnerships for oil and energy transfer. We have portfolios that look at currently that look at healthcare or that look at real estate or that look at portfolio in a can. So whatever it is that you want to invest in, there's an opportunity within the closed-end fund market space. Uh, it's an overall lower risk in that instead of buying X number of shares of 15 to 20 different companies, you're buying X number of shares of one company who owns all of these other amazing companies and pays a phenomenal dividend. And you get those things on a discount. So instead of paying full price, instead of paying 100% value, you're getting a discount on that value so that as that group closes the discount, the price itself goes up. So as the discounts close and the price goes up, that's great. Now for us, the day-to-day pricing, right, as it does this, now honestly, hopefully it does this, right? But the day-to-day pricing doesn't weigh on me like a lot of people because our goal is dividends, but really consistent dividends where we can either retire or supplement a retirement on dividends. And if we have to sell something, we'll sell something. But our goal is not selling off of stocks in order to generate income. Our goal is dividends. But the overall price point, everybody wants their overall value to go up. Because if you do have to sell something, you'd rather make money on it than not. Uh, And then last, you get access through varied accounts or varied platforms. Almost every brokerage account, whether that's a wealth management advisor or self-directed account, meaning you do everything, almost every platform has the ability to either be managed by an advisor or be managed by yourself. But then everybody has access to closed-end funds. The interesting thing, and I've said this before, our guy we still have a wealth we still have a wealth advisor with Morgan Stanley who does not like closed-end funds. And I don't know why, because they pay amazing dividends. A lot of the stuff that we're invested in, we could find in a closed-end fund and just get a better deal. But that's a problem for us to resolve for later. But my point is, whether you're doing it or whether somebody else is doing it, pick your investment brokerage account, pick your investment firm. They can get access to closed-end funds. We have them through our Webull account. We do a self-directed individual brokerage account on Webull. We also have a Roth account on Webull. And when I show those portfolios, those are our real portfolios. It's not like if I bought one share of this or I bought one share of that, it's this is what we have. So of the last several weeks, really the last several months, I've said a lot of the same stuff. And I don't like, I mean, I like repeating stuff, but at the same time, I don't like repeating stuff because quite honestly, the more it gets repeated, the less effective it gets, or the more monotonous, I guess, maybe to me it sounds. So my goal is to attempt to streamline or maybe combine a lot of those things into five key points. So one, you have to see the big picture. You've got to do your research and not solely trust your finance guy or gal to do everything for you. You can self-manage pretty easy. I mean, it's what we do. Or you can trust your finance guy or gal to do all the stuff for you, but you shouldn't. So you should take more ownership of your investment portfolio. If you like your person, that's great. Do some research on your own. Become more educated. Become more aware and intelligent, knowing about the market at large. But you also have to see the big picture in that we all like to look at things regarding how they exist in our corner of the woods, but it's really this giant forest of investment that's always going on and always getting steered here and there. It's very easy to feel like you only ever see your own individual microcosm, but the macrocosm of investment and how that relates to your microcosm, that's huge. So if you cannot see the big picture, you're not doing your own microcosm very well. So second, you got to play the long game. I mean, the whole buy and sell and buy on Monday, sell on Tuesday, flipping shares for really small amounts. That's some people love that. That's not us. The long game is don't let the current market space get you down. There's always a doom and gloom viewpoint. That's not to say somebody hasn't put a lot of research into it. So my advice is read it and then understand it and consider it and then think how it could impact you in the short run and also the long run. But just know going in that whatever metrics, whatever strategy you have, stick to that strategy until you find a way to improve it. And don't be tempted by that shiny object where the herd goes. It's like they hear a bell and they just all go in one direction, or they hear this and they all go in that direction. Don't be wishy washy like that. Know your strategy, play the long game, growth over time, dividends over time, reinvestment of dividends over time, whatever it is, and play your game. Don't let other people distract you. Third, the market always looks forward, regardless of what's going on right now, regardless of how crazy things seem right now. The market always looks forward. And pending the area of the market, it might look forward in 3 to 6, 9, 12 months. It also might look out 3 to 5 years from now, right? So we want to prioritize how we buy. So we should buy the best deals for now with the overall long-term game in mind, even when that long-term game includes the possible doom and gloom of things. Meaning, which I'll probably get ahead of myself. So interest rates are high, but they're not always going to be that way. So you have all these different sectors of the market. You want to find the best deal for you right now, knowing that the market's not always going to be the way it is right now. So wherever you think the market's going to go overall 5 years from now, right? And that's really hard to do because we're all conditioned to think of right now and tomorrow and right now and tomorrow. It's hard to look out 3, 6, 9, 12 months from now. It's really hard to look at further out. But if you can see that bigger picture, it's not that it makes investing easier. It's that it helps you get ahead of the crowd. Um, and it helps you see beyond it. It's you really do like you become your own filter. You have all this different information coming in where you can read it and process it and think about it and then talk to other people about and then think about it some more and then invest. That's a huge thing. Like if you can evaluate data and see a bigger picture, you are leaps and bounds ahead of the herd. Uh, Fourth, you have to think for yourself. So everybody's got a strategy. Do you know yours? Is your strategy based on your advisor's strategy for you, or is it your strategy? It's your money. So don't be afraid to go back and be like, hey, I think we need a different strategy. And they might push back. Why? It's your money. You can trust what they're doing with it, but at the same edge, it's your money. So you've got to have a strategy and you've got to sift the data, which means you have to know the overall context. In that, so the current interest rate market is mixed, or at least the current interest rate data is mixed. You have some core numbers saying inflation is going up. You have some key articles saying, hey, inflation's going down. You have some articles saying the Fed is going to keep rates the same. You have some articles saying the Fed is going to drop rates. And all of that tells me that no one really knows what's going on. But there still are some key takeaways from the last week. The CNN meter is on the edge of greed, which means I still think it's being skewed by technology. We have all of these people pushing money, pumping into the technology area that it's actually skewing the data for everything else. The herd we know is in technology. They've been in technology. They've been fueling technology and direct investments into technology, meaning single stock acquisitions. They're investing into NVIDIA and what is it, ASML and Broadcom and Meta and Amazon and Google or Alphabet and Taiwan Semiconductor. They're investing into the companies that are both pushing AI and the companies that are making the technology for everybody, which means there's a huge area of the market completely ignored. Like if you look at the market as a whole of like Pac-Man eating one of those little dots on the old Pac-Man screen, if you envision Pac-Man's slightly open mouth as the money pouring into technology and look behind him at that giant piece of the pie, that's everything that's getting ignored, which means you can scoop a fantastic deal, something that is undervalued, something that where people think their fears are oversold, like people think it's doing horrible, but it's really not. That pays a fantastic dividend and something that will grow as the herd shifts away from technology or as technology expands and that company incorporates more technology. So there are so many potential great investments at the moment, really because the herd is focused on technology. So if the Fed cuts rates, which is, it's hard for me to, and I've said this, I've said the Fed will cut rates after summer because it makes the most sense. Logically, it makes the most sense. It does not make the most sense on the data. I mean, if inflation is that stagflation, sticky inflation, it's actually going up, a rate cut does not make sense at all. But if you wanted to drop rates and you kind of insinuated that you would drop rates in September, why September? Because most people are home from the summer and the school year has started up. So kids are back in school, families are home, most everybody is back at work and back in the office. And it's right before the official ramp up. It's like right at the very cusp of the official election season. So if you wanted to tell all the voters that you've done a fantastic job fixing the mess you created, except they aren't going to say that part. They're going to say, we've done a fantastic job fixing the economy. Inflation is decreasing. We're going to cut rates. And they're going to hope everybody forgets that they caused the problem. But say, hey, we're going to cut rates. They want to keep their jobs. I mean, the election is a lot of things. And yes, it's one day after the PA rally, and I'm not going to get into that. That's a different discussion altogether. But the election itself is a lot of different things outside of however many candidates end up on the ballot. It's the Federal Reserve people right now, they want to keep their jobs. And the best way they can do that is convince you that they've done a great job fixing the economy. Therefore, with inflation in retreat, what they're telling you, not what the data says, if with inflation in retreat, they're going to cut rates. They want the job. So if the Fed cuts rates and they insinuate they're going to cut rates, then rates will drop before September anyway. Okay. Everybody will be happy with smaller rates. I mean, tech will be happy with smaller rates, right? But if rates go down, bond prices go up. And the herd who's in tech and is focused on that shiny object, that their little circle people are going like, hey, look at all the technology deals. When the rates drop and bonds go up, those people will change a little bit. Some of them will be like, hey, look at bonds, and the herd will be late to the bond rally, but they'll just spike prices in bonds, right? And if rates drop, then real estate will go up and we'll have the same thing, right? The herd will follow that shiny coin wherever those people tell them to look because they trust them. Why they trust them, I have no idea, right? But a rate cut overall will help more than just somebody buying a house. It'll help credit card rates and auto loans and this and that and the other, but it'll help bond prices and real estate and it'll help stocks. So where should we go? Quite honestly, wherever the herd is not at all. And it's tempting because that technology market is supposed to continue to expand for the next at least 5 to 7 years, 2 to 3 years, 5 to 7 years, right? We're not going to get away from technology at this point, but no one knows when that bubble's going to burst. The difference is for us, sure, we could pick up, and I like to buy sets in 50. I've said this before. So we picked up a set, we picked up a 50 set of NBXG, which is all 5G tech based things. Uh, and I forget the date. If it shows on our portfolio, that's when we bought it. We picked it up in the individual account, and then we picked it up in the Roth account. So in the individual account, we picked it up at like 993. It's currently at 1330. And since we buy things in sets of 50, if we bought a maybe it's 13.1, if we bought another set right now, that would raise our overall share price average. So we own 50 shares at 993. If we bought another 50 shares right now, we would have 100 shares valued at 11.5. And that's not a huge difference overall, but it's also more expensive than what it was, partly based on those companies, but also partly because that's where the herd is. But if the herd will kind of train their eye away from that and then start pumping money into all of these other things, that Pac-Man uh, focus point will change and we'll see some corrections in the market in general. And then pending the deal, maybe technology becomes the best deal. So where should we go? Wherever the herd is not, because you'll pay more for it just based on interest, right? Supply and demand. And that really holds true in the closed end fund world because there's a limited amount of shares and that there is a set amount of shares. It's a closed system. If Coca-Cola ever ran out of shares, they could just like grab a sticky note out of thin air, write you a new share, hand it to you, and it wouldn't impact the rest of the share values out there. In the closed-end fund world, it's a limited amount of shares. However many shares are there, are there. That's it. If they ever sell out, they sell out. And guess what? If you want one of those shares on a sold out company, it's going to cost you more than it would normally. You'll pay a premium and not a discount. And for us, we don't pay premium. So where do we go? Wherever the herd is not. And right now, they're in technology like crazy. So stocks, maybe, pending the portfolio. Bonds, maybe. Kind of same thing, pending the portfolio. We've been looking at funds that are stacked with fixed income because the higher for longer Fed strategy should spike the returns for the fixed income guys. But that's not going to get completely trashed if the Fed cuts rates one time. One time spurs the market. Slashed rates, that's a different story. That would that would change that strategy. But one rate cut isn't going to completely dampen the fixed income strategy. Uh, Oil itself, so oil is the backbone to energy infrastructure, utilities, and tech. Uh, it's all surging. So unless we find it inside another portfolio, we're not directly targeting oil, energy, or utilities or tech. Um, so then the fifth point is we follow the code, right? So we adhere to our code unless we have a really good reason to not adhere to it. So it's exactly what Barbosa says in Pirates of the Caribbean. The code is more what you'd call guidelines than actual rules. So the code is this: know your strategy, know your targets, see the bigger picture, understand how that fits into your microcosm, right? See how things are going, know your strategy, know your targets. Use the grander scheme data that's been synthesized into the microcosm so it's easier to weed through the options. There's, I think, maybe 20 different, we'll see in a little bit. There's maybe 25 stocks on our hit list at the moment, but we're going to take our focus points and weed through the options. It makes it a heck of a lot easier when you have a strategy. We want to, let's see, we want to buy historic discounts, which means you have to do the homework or you let me do the work for you. You want to focus on consistent and rising dividend payers. So when and how those dividends get paid matters. Do you want monthly dividends, which we want monthly dividends, or do you want another setup? Uh, and then last, be mindful of the overall dividend yield. Our focus has been on 9% plus, unless there's a good reason to buy something else. So let's see where the bargains are for the week, and we'll go from there. So this is the closed-end fund master. And I've said this before, but 3 asterisks is a buy alert because the current discount is double the historical or it's greater than double the historical and greater than the 5-year discount unless the company's new. Like if it's 3 years old, there's a little grace in that. 2 asterisks would be a dollar cost average alert based on what we already have. One is tracking for any number of reasons. If it's purple, medium blue, green, or light blue, I update those weekly. And then I update the entire thing monthly. So ranked in alpha, this is what it looks like, but we're going to rank it by discount. And then reverse rank it. So we get the asterisks. All of these companies present the initial target list. So now we sort them. Current just means what we currently own. Let's see. HFRO, sister company. We own 50 of NBXG in the in the individual brokerage, and then 50 in the Roth. That's why that's two-tone. FSCO bonds with really high fixed income. BRW bonds with not really high fixed income. CIF bonds with really high fixed income. Um, all right, so all of these have significant discounts. It's really, I'll be, well, here, we'll screen, I'll go from there. So we want monthly. So there's one pair that's not monthly. That's funny. Live video, raw video, you get mistakes. Um, all right, so one who's not a monthly payer. That leaves us with this. So then we rank by yield because the goal is 9% plus. It's really hard to ignore this company because, well, I mean, one of how they restructured their portfolio. It used to be a bond portfolio. Now it's real estate. Not all the real estate is online and operational. That's part of it. The other part is the discount. So if we scale back on discounts, that is not accurate. I love finding mistakes. Don't always love finding them on raw video. Um, so let's see. So if you have a break-even company, which these are not 0, 0, but it's close. So for this company, which is not 0, 0, but it's close, and its sister company, which is just over, for every dollar invested, you're paying a dollar. Like there's no discount. So you give a dollar, it costs a dollar. Versus this company, for every dollar invested, you're paying almost $1.63 for whatever reason. And for this one, it's the opposite. For every dollar invested, you're paying, what's that, 51 cents off, so you're paying 49 cents on the dollar. So it's very hard to ignore the discount. Some of these are, excuse me, I don't know why my allergies suddenly kicked off. Some of these are municipals. They pay great tax equivalent dividends, but this is the Roth account. So long as we jump through the hoops, there are no tax issues. So to go, like if we are investing in the individual account, tax equivalent dividend, there are no taxes. That makes sense. In a Roth account, which already has a no tax issue, it does not make sense to do the same. Excuse me. So now I'm trimming out everything that's not 9%, and we're left with this. So when I looked at this yesterday, and before I sifted through all the different financial emails I get every week, like it makes the list, right? It's tempting, but it has a really high bond allocation and a high fixed income, but we already have that. Bond fund, some bonds, bond fund, bond fund, real estate with some bonds. So I don't, quite honestly, I don't want to invest in another bond fund just to get a different angle on bonds that we already have. It's also costly. Now, if this is costly, then this is also costly. So, I mean, yes. And where is the herd right now? In tech. So this is what we're left with. And this is the list from like it's the updated list from last week, but it's what are we interested in? High fixed income, bonds and loans, and stocks, pending the portfolio. And I got into these portfolios last week. So in our individual account, I am faced with a quandary. There are some funds that I would like to hold, the ones in blue. The ones in red, I've looked at selling, and with the goal being it's an individual account, it's a taxed account. So if I gradually sell this off and reinvest it into a Roth account, it's the same amount of money, but now it's not taxed, and that ends up being a lot of money over time. Well, the Roth money, the money you put in, if you really wanted to, you could take out, per my tax guy, any dividends, like if quite honestly, if we sold this, so if this ramps back up to three, I say if because there's no guarantee, it's the stock market, right? So if this goes back to $3, then we would sell it, take the profits, reinvest them. In a brokerage account, you're paying taxes on those capital gains. In a Roth account, you're not paying taxes on the capital gains. It's in the Roth. Now, if you take the dividends or the capital gains out early, you pay a penalty on that. But so long as you jump through the hoops, no taxes. So everything in red, we've considered selling, and selling at different price points or different gains than what we currently have. This one, what I'm currently in the midst of doing, I'm digging through this portfolio compared to the other MLPs we have, KYN and then NML, uh, between oil and natural gas and just energy transfer overall. But comparing portfolios, because this used to be a closed-end fund. It was this closed-end fund, and then it merged. Now it's a mutual fund, which is structured a lot differently. And they absorbed the closed-end fund into the existing mutual fund that pays, about the same. It was paying 7.7, currently paying a little over 8.1. We used to have a 200 shares that paid decent, and now we have 54. Um, Not many shares. So the I guess what I'm looking at is comparing portfolios, because if we're duplicating what we already have, then that goes to Warren Buffett's thing of it's diversifying for the sake of diversification is just not smart. It's butter scraped over way too much bread. There's not enough butter for all the amount of bread. So if this is built the same way or similarly to the other two, which I knew what it was before I really knew the portfolio well before it merged into the mutual fund. But regardless, so maybe that's a good thing to sell right now. And we would take the proceeds plus whatever dividends are in the account, withdraw it, and then deposit it into this account. And then I just track our overall contributions here. Um, and I say that because of what we have and don't have. So the focus overall, so you get high fixed income, bonds and loans and stocks. If if the Fed is cutting rates, bond prices will go up. So you could argue for an investment into any bond group, uh, just based on bond prices are inverse of rates. So if rates drop, bond prices will go up. Fixed income, higher for longer. One rate cut is not going to be a super low interest rate. Uh, so the fixed income strategy stays in place. The stocks part, and I was not looking, I guess you could say, to invest in stocks, but the more I hear, the more I read. So in the current market, if we were really going into a recession, I would imagine people would buy bonds. But that doesn't seem to be the case because of all the individual Tech funds we're seeing being bought, those are stocks. Uh, we go back to our portfolio. Let's see. This is all stocks. Um, rank it by target again. NVXG is at the top. It's a ton of assets, but it is all stocks. It's just the current shiny coin. So if we looked at a stock portfolio, it would have to be not so much a portfolio when it can, but it would have to be spread out in areas that we thought would do well in the coming years and long term. Not right now, long term. And when I looked at this portfolio, like I get the spread that Morningstar has, tech, consumer, finances, industrial, healthcare. I get that. But it also just boils down to all being a tech account. It's just not labeled that way. It's we're so used to categorizing things based on label. Grills are consumer products. So are ketchup and mustard and pickles and hamburger buns. So are cars. Uh, Cyclical products that come in style and then leave. They're fads depending on the time of the year. So grills leading up to Memorial Day or at Christmas time or uh, like TVs before kids go off to college and uh, cars for the summer or the winter or like in a recession, ketchup and mustard, supposedly. But consumer itself is way too finicky for me overall. It's way too finicky of a category, especially in a global fund. And I get it, this is a global fund. But all of those companies are not just consumer companies, they're all tech companies. Cars right now are so tech. I don't know if you've seen this story. Cars right now are so tech that in a congressional law, every new car by 2026 has to have an installed kill switch. Who controls it? I have no idea. That's a conversation for a different day. But cars are so technologically advanced right now, it's crazy. Supposedly, that's a consumer product because they're cyclical of how people buy cars. That's a technology thing. Nike and how they design shoes. Yes, is a consumer product based on the cyclical nature of when people buy tennis shoes, going back to school, going off to college. But it's a technology thing of how they design the shoe. Uh, it's not as simple as it used to be. And when I look at this portfolio and I see everything that's in the portfolio, I see a ton of technology and a ton of promise in technology, and not so much the breakdowns that we normally see. So for our portfolio that's heavy on bonds, long term for a reason, um, it's tempting to buy this fund because it's currently undervalued, still pays a 9% yield. I love what's in the portfolio, and the dividend is rising. Uh, and in a lower rate market, it should do well. So what's tempting for me is to sell the closed end fund that got sucked into the mutual fund and then so withdraw the money, load it into this account, and then buy buy this fund. So of the money we have, we would spend here because bonds, fixed income, and it's what we have. Of the money we don't have, we would do this. So we still have the same money, right? We still have this money. So of the money we don't have, we would still keep that $100 or that 100 share buy, but we would also do this. It does not have a high amount of fixed income, but Part of it is just the 250. I mean, I like sets of 50, but I also like rounder numbers. That's a small edge to it. The other part is BRW is forcing moves inside the closed-end market space that I like, and they're getting crapped on for it, which I don't like. I mean, we own the company. The overall share price has dipped a little bit. Let's see, 7.1 right now. It's about on track on the average of when we bought it. But it has not escalated like I would have liked, or risen like I would have liked. But they're taking on closed-end funds like BlackRock and forcing them to make changes at their company. I like that because if you can force BlackRock to be more pro shareholder and change dividends, then if BlackRock is being forced to do it, everybody else is forced to do it because they're cutting, they're reducing fees, they're forcing their managers to work harder, and they're putting shareholders first. And as a shareholder, I like that. You should like that. So for a company who's willing to take on the biggest dog on the street and win, I like that. So yes, it's a bond fund. It's got mixed for whatever reason has lower amounts of fixed income. But what they're doing in the background, I like. So I'm willing to buy a little bit more of the company. So for the money we don't have, it's this. For the money we do have, it's this. And those are my picks for the week. So stop share. There we go. So if you like my content, if you like my commentary, consider subscribing to my channel and hit the like button. It really does help push videos out to other people. Uh, Regardless of what you have going on, regardless of what you have going on for the week, make progress. That's the biggest thing. Make progress. It is so easy to coast, meaning, and I use this analogy a lot. As a captain of a ship, metaphorically, I don't remember that whole fun Jack Sparrow quote, but metaphorically, we're piloting our ships to a specific destination. It's hard. It's grueling work. It's not exactly rewarding all the time. So it's very easy to just sit and take a nap and let the boat go where it wants to. But that doesn't really help because those dreams you have, they exist and you probably can't see them. Like you can see them in your head, but you can't see them in your line of sight, depending on where you are in retirement or how close you are to accomplishing those dreams. But if you're piloting your ship towards your destination, knowing that it exists somewhere off in the eventual horizon of what you can see, your immediate line of sight gives you all the information of what's around you. Your vision of what's beyond the horizon is what's leading you forward. It's very easy to feel run down. It's very easy to want to take a day off. The problem is the more days you take off, you end up sleeping longer than you want, and the boat kind of wanders where it wants to go. That boat will go wherever the wind pushes it, unless you tell it where you want it to go. And if that doesn't make any sense, then go over to Facebook and check out my group there. Right. But in order for you to realize your dreams and then live beyond that, you have to pilot the boat. Nothing is going to make those dreams happen randomly on their own. If it could have happened on its own, it would have happened on its own, but it hasn't. Make your dreams happen. Work for them. Do not work for them trapped inside four walls and a ceiling and never see your family. Not that. Life does not happen at work. Life happens beyond those four walls. But don't get so lazy that you forget to work on your dreams and you forget to realize your dreams. Make progress, even if it is just making sure you're piloting the boat every day and making sure you're gaining ground. So, whatever you have for the week, I hope it goes well. Um, yeah, come check me out on Facebook and see what I'm saying there. Otherwise, I will see y'all on another video. So hope you have a great week. Bye bye.